Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending April 10th, 2020. I'm Preston Brent. Thanks for tuning in. This week's theme is running with the bulls. Well, all the indexes in the US were up strong. I mean, the Dow was up almost 13% for the week, 12.87. Year to date, it's down 16.89. So we've moved out of the bear market. As quick as we moved in, we've moved out. The S&P up over 12% for the week. Year to date, we're down 13.65%. NASDAQ this past week, we're up 10.59%. And keep in mind, this was a holiday shortened week. Year to date, we're only down 9.13%. And the Russell, it's the only one that's still in a bear market officially. We're down year to date 25%, although this past week it was up a whopping 18.5%. Just amazing. Volatility came in. We actually moved in below the 50 level. Last week we closed at 46.8. This week we closed at 41.67 for the VIX, so that's down a little bit over 10%, almost 11%. And worldwide markets also did very strong too. The FTSE, CAC 40, DAX, Nikkei, Chinese markets, Hang Seng, all of them up very strong. This week we also saw the strongest weekly sector performance in materials. It was, I mean, you're not going to believe this, it was up 21.3%. Now that's the sector, okay? Communication sector was the worst performer, and it came in at 8%. Now, the trailing 12-month PE ratio is coming in at 21.19. The forward PE is, I think, a little bit higher than it should be at 18.81, but that's still lower by about 11% from the trailing 12 months. The S&P annual dividend yield is at about 2.13%. The 10-year interest rate's at 7.2. 72 basis points, almost 73 basis points. So we're still have a strong advantage for passive funds to be in the equity market. Okay, I mean, just a very strong advantage there. So again, the market saw a reason to cheer this week with this global, worldwide running with the bulls. Largest bounce we've seen here in the U.S. since 1984. Okay, essentially though, the shutdown was man-made, but we don't make the timeline as much as the virus does, but this is where analysts are really varying in their estimates on where we're going to go from here, the impact on the US GDP numbers and so forth. I mean, we're already seeing a lot of analysts come out with different recovery terms using letters of the alphabet, like a V-shaped, U-shaped, a W-shaped, an L-shaped, a Nike swoosh-shaped. Nobody really knows for sure, okay? But what they do and don't know, or what they don't know for sure, one thing we do know for sure is the U.S. Federal Reserve is just unprecedented policy response, which I think at this time was a good thing to do. They put in more than $2 trillion with another $4 trillion sitting in reserve that can be used by the feds. So these trillions in liquidity provisions, you know, they're looking to fill the gaps in some of this enforced shutdown in the economy. Okay. And I think what's going to be really hit hard are the emerging markets because they've gotten by a lot on foreign borrowing. We've seen the U.S. dollar kind of a flight to safety with the U.S. dollar in there. But, you know, since the market peak in February, we've seen about 6.9 trillion in value of U.S. stock holdings fall. So even though this past week, we've had a couple of double-digit weeks where the markets have moved up, which I guess should be expected really, guys, in these severe bear markets. But we've had the fastest, or let's say the fastest fall in the history of the markets, not since the Great Depression, and then one of the quickest rises in the markets as well, which should be expected. We've also seen, I've seen the U.S. Feds come to the rescue of high yield bonds. Okay, they've announced plans to move into more of the junk bond area, but typically that in the lower end of the high yield, which is our investment grade, which would be triple Bs. And then a lot of them moved into junk status, but the feds have come out there and they're buying some of this stuff. Now that's reduced the spread from junk to investment grade by over 85 basis points. So that helps to soothe the market. So if you look at HYG, it's an ETF, or JNK, another ETF that tends to track the junk or the high yield debt market. They gained a tremendous amount this past week, over 6.5% on Thursday alone. So that helps soothe and calm the credit markets, because as I always tell you, and certainly with our members, you've got to focus on the credit markets, and that'll kind of dictate where we're going to go with the equity market. Now, one of the interesting things that I'm seeing, if we're talking about debt and equity, is this. I saw this statistic. and I also saw a little write-up of it in Barron's this weekend as well. We've got a ratio of market volatility, and it's a ratio of the equity volatility versus the bond market volatility. And we're seeing equity market volatility at the 99th percentile since 1990. I mean, we're up very high. So I don't need to tell you that volatility is high in the equity market. But I may need to remind you, or at least tell you, that the market volatility in the bond market has collapsed. It's down around the 16th percentile. So when we've had this wide of a divergence, and remember, bonds tend to lead the way, this would suggest, looking at statistics, it doesn't haven't happened that often, but this would suggest that it's mostly bullish for equity markets because the bond markets typically lead the way. Okay, now time's going to tell, but if you go back and look at statistics, when you've got this wide of a disparity between volatility in the equity market versus the debt market, meaning the equity market is very high vol and the bond market is very low vol, then you typically see equities move over time, let's say over the next year, 20%, 21% higher than a normal move, which is about 7% higher. So this would tend to just promote and suggest that we can see more upside movement in the markets. Now, again, as I said earlier, this is a man-made event. It wasn't a structural issue like we saw in 2008 and 2009. So I think all these people trying to compare this market collapse to the collapse we had in the dot-com bubble or the 08, 09 is missing a major factor here. You've got to throw in the human psychological component. There's a big study going on now. It's just kind of been starting over the past 4 or 5 years, behavioral finance and the psychology, the human psychology of the markets. And if you look at that coming out of this, you're going to see a lot of debate. And I think it should be good debate on how soon will people come back. My view, essentially, everybody says it's going to be different. Everybody says it's going to be different this time. Everybody says that, well, people are going to remember this and they're going to change everything. But, if you just look at history, people don't change. Psychology doesn't change. People react the same way. There's fear and greed, and it manifests itself in different ways, but there's still fear and there's still greed. Okay. So it's almost like, I guess, another analogy would be, those folks that have gone out and just drank too much, and the next day with a headache and a hangover, they said they'll never do it again. And then about a year later, they do the same damn thing again. So patterns tend to repeat. And although we do have a different cause for a bear market or a bull market, it'll manifest itself in different ways. Patterns do repeat. In this particular case, of course, it's different. It's man-made. So we're going to see coming out of this just how over the next 2 weeks this is going to come forward. Now, also this past week, we saw U.S. inflation, needless to say, stay very weak. CPI reading showing prices decline about 4% month over month from June. And that's dragged our annual inflation rate down to about 1.5%. But eventually, we're going to see all of this monetary stimulus put into the markets by the Fed to begin to really feed this inflation engine. Near term, though, no. Longer term, yes. That'll be bullish gold longer term. Short term, not as much. And that's why we're getting a lot of volatility in the gold markets where it's moved up and down. We've made within about a week and a half period 2020 highs and 2020 lows in the gold market. What you see on the screen right now is an Ichimoku chart. I've got it on a 240-minute time frame. It's my favorite time frame to analyze rather than a day chart. Gives you a little bit more sensitivity to it. You can see I've got some other things on my screen. The dashed yellow lines are key pivot levels, key price levels. The solid lines, colored lines, or key Fibonacci nodes. You can see on this chart, we're hitting the nodes. All right, we're hitting what we should be hitting. You can see that colored bar right there, this colored bar right here, and then this empty one right here. All of these are formed by using a combination of Fibonacci nodes, extension nodes, as well as Gann time series. And you can see we've hit these and we've run into resistance each time we've hit them. Okay, now we've got this other one up here. So we've got a tremendous amount of resistance here, and then we've got what I would call our R1 level, is our first level of resistance above it, right around 2853. Notice we've got an Elliott wave 3 and an Elliott wave 4, major Elliott wave 3 and 4 with minors underneath, right? But you can see that we're on a four leg up, which would suggest we're going to see some weakness here. You can see we've also gone green in our Ichimoku, which does suggest more upside potential, but it's down below. So we've got this S1 level sitting down here in this zone here. And notice it's moved up. So it's just tightening up, and it's suggesting we need to tighten our stops, obviously, as we move forward in time. This colored bar down here is a suggestion of where the Elliott Wave 5 could go. So you'll notice a lot of analysts have said, we're going to retest the lows. I'm not so sure of that just yet. Okay. If I had to draw an area that I'm going to watch, is going to be this area right here. I'm going to just draw that line right there, and you're going to see it. You know, that is going to be the area that I want to see that we can hold up. It's roughly just below the 2,500 level. Okay. If we can hold that, then the low has been made. If we take this out, then we're going to come back and retest this here. We do have corporate earnings coming up this week. And next week, Tuesday and Wednesday, we get banks kicking off with JP Morgan, Wells. We get Goldman Sachs on Wednesday, Bank of America on Wednesday, Citigroup on Wednesday, US Bank Corp on Wednesday. PNC on Wednesday. We've got a ton of banking, and they typically lead off the earnings now, unlike Alcoa, which used to be the lead-off batter for corporate earnings. So we're going to get a good idea this week and next week just how severe the write-down is going to be. I'll remind you that over 200 companies have refused to give forward guidance for the remaining part of the year. Many of them have said they're going to hold off on guidance until when they know better, and they were touting time frames around end of May, end of April, sometime in early May. Okay, so that's, analysts here, and it's just kind of left to the analysts to just guess, hold a finger up in the air and see which way the wind's blowing. The market seemed to be optimistic. Okay, the Elliott wave seems to indicate we're going to come down and make new lows. But for me, this is the area that I want to watch, just around the 2,500 level. Okay, if we can hold that up on a drop and a pullback. We're going to get a little bit of a pullback, but if we can hold that up, that will be a solid sign. Again, a lot's going to be determined on just how big the write down is going to be, but everybody's expecting a big write down in earnings on a go forward basis. I think they're too optimistic right now. But what nobody understands is, when are we going to be able to get the economy running? And when we do, because we will, how long will it take? The other wild card in this that's not factored in any of the estimates that I've seen is going to be how quick would things change if we come up with not a vaccine, but a treatment drug that will assure you that if you did get COVID-19, you're not going to die. It's just going to be like a strong case of the flu. That will give the psychological element a big boost, and you would see people being able to come back quicker. And then each company is going to, depending on how their workforce is structured and their technology, and is it a people business where people come in like restaurants, or is it something they can service from their homes? That's going to determine some of that. But the quicker that can all be resolved, the quicker we can get back to normal business in the market. So this is a little bit about what I'm seeing right now. And when you see people say, well, we're going to retest and make new lows, they're going on prior bear market patterns. And I can't tell you that that is what I would expect right now. I would expect some weakening in price, but remember, we've had this nice bull run here, and we've been on this bull run. We've played this bull run in this market. And we had a situation here where we had a little bit of a pullback. I called this pullback for our members because we had indicators that was indicating this, but then we did not come down. We held the 2,400, the 2,500. We were kind of dancing around it. And then boom, we took off again. So right now, the chart price action suggests we're going to get a dip, but the dip is not going to be severe. Okay, it is not going to be severe. We've had this extended this four leg, which could shift to a three leg. The count could totally change on us. Okay, if we look at the MACD, you're going to see on the MACD here that one of the things that gave me this is going to be a little bit of a deeper move here, and it was. I mean, we moved from roughly right around 2634, right at that level right there, okay, all the way down to this level down here, which is around that this level right down here is around 24.45. So we moved this level right here. It's about 190 points roughly. That's a big move, okay? And we've got this because we had this beautiful bearish divergence set up here on this 240-minute chart, and it triggered right at that colored point right there, and that was when it was a good time to go short, right? Or just because we were getting more long in this area here, taking some of our shorts off and getting long here, and then this was another place to dance with the devil, going back short again. But it was a shallow move, and then boom, we started moving right back up again. And then I said, when we take this level out right here, we're going to run up to this level up here, and that's exactly what we've done. And now you can see that clear bar or that circle right here. This is going to be our next support point. Every time we've hit these points, we pull back. Okay. And then the issue is, well, just how far do we pull back? So we hit that point perfectly, and we couldn't climb higher, and we pull back just a little bit. We hit this point perfectly, and we pull back a little bit more severe. We're now hitting this point right here, so that would suggest a pullback. Now this is a very shallow range right here, right around the 20, let's call it 2700 in round numbers, right? So that would be our S1. Our S2 level, our second level of support, is going to be right back down at this level here, right around the 2634. And then the 2600, which is everything that ends in a zero and a century mark, is just going to be a natural area for price action to kind of just pause here for a day or two. And then the next big one is right down here, which is what I would label our S3, around 2500. So this is what I'm looking for, guys, not necessarily move right back down here. Doesn't mean we can't get down there. We will play it if we do. Each one of these levels that we break to the downside, it will increase the opportunity for us to continue to add. But I would not be looking at going long right here. Now, we've been adding to our positions down here as we've been moving down in this tight little pattern here with some stocks that I like, that I think are pretty good buys down here. And like I said, you got to kind of think like a banker. You know, you got to get stocks that have good cash balance sheets, and there are plenty of them out there that you want to look at. That is just, you know, you can have them on a fireside sale now, and you definitely don't want to let 2 or 3 years go by without picking some of these up. For our members, we'll review again some of these stocks that we've been picking up, whether you're using options or just pure share purchase to do it with. But that's kind of what I'm looking at in the markets, guys. I'm going to switch the screen over just a little bit. Let me just come over here, and I'm going to take you to another screen. Let me just get it over here. Let's see what we're going here. What number is that? This is screen number 5. All right, so it's the same chart, only I'm going to daily. It's the E-minis. You can see here, as soon as it paints on the screen here, I'll show you. You can see, same chart right here. You can see down below, if I move it up just a little bit here, you can see down below we've got a tremendous amount of support just below us here. Okay, if you recall from the prior chart, that colored bar was sitting anywhere from 2000 to 2100. Okay, and if you look at this chart right here, a lot of that is in this area right down here. Okay, right around the 2000 mark to the 2100 mark down here. All of these were key levels, key instances back in 2016, the pre-Brexit vote, the post-Brexit vote, and the overnight Trump election lows. Okay, so if we come down here and take out our 2020 lows, which was at 2174 for the E-mini S&P 500 futures, I don't think we have that much further to go. And then we're going to find a lot of support here, and I think you're going to see more buyers come in willing to pick up share price, okay, or shares, because there's just some really good buys down at this level down here. And because the economy was fundamentally strong, then when we come back, I think we'll come back in force. But remember, just like a car, if you leave a really nice, strong, running, no problems running car in the garage for a couple of years, and you come out and kind of crank it, well, you know the battery's going to be dead. But even then, if it's been sitting for a long period of time, it's going to take some time and a little bit of maintenance to get it running good again. Same thing with the economy. The U.S. economy is not meant to be shut down like this. In fact, we've never done this before. So that's why we've got a lot of varying degrees of analysts calculations as to what's going to happen. But eventually things are going to come back. and we're going to see things get back to a more normalized, or what the new normalized version is going to be here in the next 90 to 120 days. Okay, but this earnings season, this earnings quarter is going to be a big factor on just kind of where price action is going to go, and it's going to be weighed against, the New York pandemic, and the curve's been flattening in New York this past week. This weekend, with Cuomo out saying it's continuing to flatten and go down, number of cases are going down, so that'll be a good thing. So now all eyes are going to be on this new task force that Trump's setting up on the get the economy rolling again. And he'll be well served to keep it apolitical, and then just get people from both sides of the aisle on there to see what would be best and how to get this economy rolling. So that's a little bit about what I'm seeing here in the markets. I mean, it's not any more complicated than that, guys. If we look at the VIX, you can see with the VIX on this daily chart, we're now back into the red zone again. We were up here about 18, 19 days. In 2008, we were up about 27 days, 26 days. We fell into the red, and we went back up for another 27 or 28 days, for almost a total of 8 weeks into the black swan area over 50. You can see, if I move this down, that 96.40 was an intraday high back in October 2008, but we did not close up there. In fact, some of the closes here were higher than 2008. We closed over 80 a couple of times here. We didn't do that in 2008. But we did have an intraday high higher than 2000, than what we had now back in 2008. So you're seeing volatility starting to come back down. Now, keep in mind, as I told our members, vol can come down, and we can still make new lows as vol starts to lower itself. If we look at the front month skew, you're going to see it looks a lot better than it did before. If we look at the front month vol skew, you can see we're not quite in the green yet. All this just means is vol is going to expire this Tuesday, and then we're going to switch over to May as the new front month vol futures. So when it expires, both the VIX and volatility have to equal itself. So probably a better view of the skew, because this expires equal, which means right at zero, would be to look at the back month, which is looking at April and May. So if I click on the back month skew, you can see we're still in a backwardation. All right, that does show fear all the way out through May. In fact, fear is running all the way out through the fourth quarter of this year, because the markets just don't understand just where these markets are going to go right now. Okay, so we've got a backwardation that goes all the way out through Q4 of this year. This too will come down the minute we get more insight into the virus, and how soon we can get the economy running again. Okay, so that's a little bit about what I'm looking at here. And of course, if we look at the bond market, it's gone a little bit haywire with the Feds in here. I do believe the bond market is going to work its way slowly back down. And should we start to see an all clear and the economy come back, bonds are going to be back down in this area down here around 157. Okay, so this intraday high here, and these were more of a panic, and now what's keeping it elevated a little bit are the Fed, because they're out there buying across all durations in the bond market. They're also buying in the municipals. They're buying ETFs, as I said, in the junk area, high yield. They're buying across the whole thing, just to kind of keep liquidity and stimulus in the markets. And if we look at interest rates, we look at the 10-year rate, you can see here how it's off the bottom. The bottom was made back on March 9th. Okay. And now you can see where I think it should be. What you want to see is interest rates moving up just a little bit slowly, not fast, but slowly as the markets move up, which means as markets move up, bonds move down. That's what you want to see. But we got so much Fed intervention and stimulus running through the veins of the debt market right now, it's really hard to kind of get a handle on it. But that's kind of where I think we're going to be when we normalize or get back to as close to normal as possible. And then, of course, if we look at the US dollar, well, the US dollar on this daily chart, you can see here, I think longer term, the dollar is going to come back down. Right now, everybody wants to be holding the dollar. You can see here, if I look at the, and this goes way back, right? Look at the regression channel of the dollar. This really started back in the summer of 2018. And then you can see this big, massive move in the dollar right here, this just huge dislocation. That dislocation is now starting to normalize again, and we're coming back to trend, which is up, but right in the center here. This dislocation was when we had the pandemic scare, the markets crash, and the Fed start coming in and they start buying everything. And then they went into these reverse swap arrangements with countries, sovereign countries and central banks around the world. So the Fed was really acting here as it did in 2008 and 2009 as the global central bank. All right. And they were making it easier and more liquid to find U.S. dollars so that there was not a hoarding of U.S. dollars, all right, because central banks tend to hoard them when the markets get batshit crazy like this. So now we're getting back into more of a normalized mode. That's a good thing, guys, getting back into this normalized mode here. If we look at the British pound, now this British pound right here, if you guys recall, and I think I mentioned it to you guys too. I gave you a freebie here on this thing. I was down in this area here for our members. I was saying we got to get long the British pound because it's just too low. $1.14 for a pound, that's crazy. And the way to trade this would be with FXB, Foxtrot X-Ray Bravo, right? And that would be it's low hanging fruit kind of trades like these that you want to take a look at. Now there are others that we're running for our members. We've gone through a number of them, and we're going to go through some more this Sunday. If you're not a member, I highly encourage you to come in, guys. I'm telling you, with prices like this, there's some stocks you don't want to buy, but there are others that you just got to jump in. Whether you use some leaps and options and calls, but you just got to take advantage of these market dislocations because they don't happen very often, as you know. So that's the British pound. The euro is going to come up just a little bit here, but we're still below the, just like I showed you, the dollar was in this nice up move. Here's the euro. You can see the regression channel, and then you can see this big dislocation, and now the euro is going to kind of continue its track down in the near term. All right. So the same thing with the euro. I just don't know. I think Europe is going to fare worse coming out of this than the US. They're trying to herd 19 cats, 19 countries, differently run. Fiscal austerity is completely different in the southern part of Europe than it is in the northern part of Europe. And it just creates a lot of issues. They finally, fortunately, passed a 500 billion euro stimulus package. They were arguing about it, but they finally came to terms on that. So that'll help the euro a little bit, I believe. And if we come down here and we look at gold, right? Gold had a nice strong week. We came up here, and if I were just to kind of move it down, you can see here if I just adjust it and just come in with the we made a during the week, or at least on Friday, we made new highs for 2020. You can see it wasn't just at the middle of March. We were at 2020 lows. We had these dislocations out here. Now gold is up at this area here. And one of the reasons why is because of all this fiscal stimulus. Gold buyers are believing that inflation is going to come back. It will, but not right now. I think it's at least a year or so away from rearing its ugly head. So we're going to see gold come back down, and then I think there's going to be another buying opportunity. But if you're playing gold long term, it'd be a nice move. I like it longer term. Okay. So same thing with silver. Although silver, if you look at the ratio chart of silver to gold, I think I like silver more than gold. Just because gold's gotten ahead of itself. But silver was a definite buy down in this area down here. Remember, it's $5,000 a point. Or if you buy 5,000 shares of SLV, it equals one futures contract in silver, if you wanted to do it that way. But you can see silver's move back up. Now, you can see the trend was down, right? You can see this regression channel trend was down. But I think it's going to come back into this chop area just like gold for the near term. The opportunity to buy was back down here, but there's other commodities that I think give you a great opportunity to buy still, even to this day. And we'll talk about those for our members. And speaking of another commodity, let's take a look at oil. Oil has just been up and down, and OPEC came out and announced about a 10 million barrel per day production cut, but I don't think that's going to be enough. Okay. Remember, the best thing for low oil prices is low oil prices, and then they recalibrate. Now, can oil go lower? Yes. I think oil can come down a little bit lower, but I want to play oil. And for our members, I'll go through in detail this Sunday evening some good ways to play oil. All right, there's some ways that seem obvious, but you don't want to do, and there are a couple of plays in the pipeline side and the exploration side that I like as well. Okay. Same thing with nat gas and gasoline. If we look at gasoline, I mean, gasoline, my goodness. The gasoline futures market was down around what, 30 or 40 cents a barrel? A low of 37 cents a barrel for gas. Come on, guys. Yeah, at the end of time when we run out of automobiles and we're no longer using gasoline, but you cannot not buy here. Okay, there's different ways to play gasoline as well. And you don't buy it to trade week to week. You look at it for a course of a 12-month period, and then come back and look at it again. Put it in a shoebox, and then open it up 12 months later. Promise you, gasoline's going to be higher. Okay. So anyway, these are just some of the things that we're looking at. Same thing in the ag market. In the softs market, there's some other stocks out there that are playing as well. So for members, I hope you guys are having a really great holiday weekend. Non-members, love to see you come in and play with us. Come on and dance with us. We're having a good time. These dislocations are great, especially in the commodity market. Otherwise, everybody have a great holiday weekend. Hope you're enjoying the day off, I guess, for Friday for most markets. And then we will see you members this Sunday evening, even though it's a holiday weekend. There's just a lot to cover. And then we'll be ready to go for next week as we kick off earnings on Tuesday, really, with some of the banks. Tuesday and Wednesday will be some big days. Have a great weekend, everybody. I'll see you members this Sunday evening. Ciao.